Hi, folks. Welcome back. Sad to see the summer go here on the northern Jersey shore. However, I do love local summer. But even though the stock market doesn't usually do well in September, I always look forward to September, especially up here. So I hope you guys had a great summer, and I hope the rest of the year pans out wonderful for you. Well, today I have August 2025 market and our value line portfolio review. August was a month of contrasts. A strong U.S. economy still standing firm against the backdrop of historic market imbalances. On the surface, stocks marched higher, but beneath, the momentum shifted. The gains broadened a bit beyond the tech giants that had carried the rally, and that's our story for today, the broadening of the stock market. Think about it like this: three waves colliding at once. Stock valuations surged to levels we haven't seen since the dot-com bubble. Yet the rally finally spread to more companies. Bonds stayed mired in their longest downturn ever, and housing, a split reality. Impossibly expensive for buyers, but finally some relief for renters. It was a month of conflicting signals that set the tone for everything else. We witnessed a quiet but powerful shift in August. For months, the tech giants, the Magnificent Seven, hogged the spotlight, but in August, money started to flow into small cap and mid cap companies. That rotation was the defining story. A tug of war between strong corporate earnings, a softening labor market, and growing belief that the Fed will cut interest rates. Scoreboard tells the story. Small caps, measured by the Russell 2000, it's the IWM ETF, let more than 7%. That's the brown bars were the month. Year to date is the yellow bar. So you can see that we had rotation into these small cap stocks, and even though the S&P was positive, the NASDAQ was positive, not nearly as much. But you can see the yellow bars are the year-to-date performance. And of course, the S&P is well ahead of the IWM so far, and the NASDAQ is further ahead still. So the scoreboard tells the story. The small caps measured by the Russell 2000 let more than 7%, the clearest signal that confidence is starting to spread. The S&P 500 index, the big benchmark, market capitalization weighted, that's the one where the Magnificent Seven owns 32% of the 500 companies, which is incredible concentration. That index gained about 2%, while the NASDAQ 100, which we effectively follow the ETF, the exchange traded fund for the NASDAQ 100, which we affectionately all call on Wall Street the Qs. Its ticker symbol is QQQ. So the NASDAQ 100, it's loaded with mega cap tech stocks. It eked out less than 1%, still the leader for the year. Yes, but August proved that leadership isn't as narrow as it used to be. On the winners list for the S&P 500, we saw the economy at work. Deere, Johnny Deere surged 18%, riding strength in equipment demand. Entergy climbed 15%. And when OK, the energy player, the gas company out of Oklahoma, rose 14%. On the flip side, growth darlings stumbled a bit. Paycom fell 22%. Mohawk, which is the flooring company related to housing, obviously, collapsed nearly 18%. And then Tesla, which had doubled earlier this year, gave back 15% in a single month. Even favorites aren't immune when expectations run ahead of reality. Sector by sector, the rotation was unmistakable. Energy rebounded as oil prices stabilized. Industrials surged on reshoring and automation demand. Financials finally found their footing thanks to strong consumer and revived capital markets. On the losing side, technology took a pause. Valuations are stretched to record highs there. And utilities, normally a safe haven, trailed badly in a market that favored risk. The numbers look great on paper. Earnings for the S&P 500 rose more than 10% year over year. Double what analysts expected at the beginning of reporting season. But that strength hides a dangerous imbalance. Nvidia, Microsoft, and Apple alone now make up more than 21% of the entire S&P 500. That's right. 3 stocks make up 21% of the entire S&P 500. That's concentration risk at a level we've never seen before. If just one of them stumbles, the ripple effect hits everyone. And just a quick reminder to everybody watching this, that's why when you own the S&P 500 index fund, the SPY, or any other index fund that mirrors the market capitalization weighted index, there's a high amount of risk in doing that you don't see. Did you know that 20+% of your portfolio is in just 3 stocks? If that was the case, you probably wouldn't do that in your own portfolio, have that much concentration risk. So just the thought that our method of owning stocks of good companies and not owning products or funds or ETFs even, for the most part, remember, our strategy is to own individual stocks. That way we control the tax ramifications and we also control the concentration. We determine how big this position size should be in each of our portfolios. Just a thought I want everybody to understand as we see this unbelievable concentration risk. In fact, the top 7 companies, the Magnificent 7, are 1/3 of the portfolio. That is very, very high concentration risk. So if they stumble, the index is going to fall. And that's why we did the rotation that we did in August. Okay, back to the presentation here. August was full of data points that kept markets on edge. Early in the month, the jobs report shocked everybody. Only 73,000 jobs were added, and that was way below expectations. And with unemployment climbing to 4.2%, the ISM Manufacturing Index, which is the Institute for Supply Managers, that's their what used to be called the Purchasing Managers Index. So the purchasing managers at manufacturing companies are surveyed, and they basically, they're the ones that buy inventory and parts and other types of things. They have a lot of leeway in understanding what's going to come in the near future for their companies. So it's very good to talk to them. And every month we do. And we showed a mild contraction, so it's below 50. And historically, that is a contrarian signal, folks. Remember, a lot of times in these surveys, when the mood is a little bit contractionary, we like saying that's probably a good buy signal. Inflation did ease to 2.7%, better than January, but still above the Federal Reserve's target, which is 2%. And we don't know where that came from. And I don't know why they have it. 2.7% is mild inflation. It's steady inflation. It's what everybody had before we had the great financial crisis. What's the difference? The Fed thinks they know, but folks, they don't know. But anyway, so we have 2.7% inflation, which could hold the Fed back from easing. So when the jobs number came out, everybody thought the Fed was going to ease in September, and then the market shot up that day, in fact. And then we got this inflation number later, the next week, and then everybody was talking about inflation again, that the Fed might have to be on pause. But anyway, needless to say, the lower interest rate expectations caused a boom, at least in August, for the smaller cap stocks. And gross domestic product, the economy, rebounded at 3% annualized rate, powered by consumer spending, which is really misleading, because we did have a terrible first quarter because things were being imported like crazy to beat the tariffs, and imports are a negative to GDP. And so they stopped importing in the second quarter, and that reversed itself. So we don't have a 3% economy. We have more like, at least if we average the first 2 quarters, more like 1.25%, something like that. But still, the futures markets, all said and done, see an 80% chance of a cut at the September meeting for the Federal Reserve. So we're still expecting lower short-term interest rates. All of this left the Fed holding rates steady, but futures markets now see an 80% chance of a cut at the September meeting. While the United States wrestled with mixed signals, international markets pulled ahead. Overseas stocks are up 23% this year, double the S&P. And that's the first time in 11 years that the overseas markets are beating the United States, which is probably a good thing. Again, a broadening out of the rally. Now, why is this happening? They had attractive valuations. Like I said, they were lagging for a long, long time. And also a weakening U.S. dollar. So a weakening U.S. dollar takes people away from investing in U.S. stocks, because the dollar itself means that their investments are going to be cheaper or go down in price. So we also have waves and waves of foreign direct investment because of the lower dollar and because of the tariff policies flowing into America from Asia and Europe as companies adapt to the entrenched tariffs. That right now has not showed up yet in the stock market. It's starting to in companies like Deere and other companies as production comes back into the United States. But it does speak well for future growth rates here in the United States. Global trade is reshaping itself, and investors are certainly taking notice. Looking forward, September is always tricky. Historically, the weakest month for stocks. The bull case is simple. The Fed cuts rates, Risk appetites expand, small caps keep leading, and the market broadens out. What's the bear case? Tech valuations are still stretched to absolute extremes. We haven't seen them since the dot-com bubble burst back in 2001 and 2000. And if inflation surprises or the Fed turns hawkish, volatility will spike hard. Either way, September won't be dull. It never is. September is the worst month of the calendar year for the stock market. So what should we be watching most closely? 3 areas. If they keep outperforming, it confirms breadth. Second, financials. Banks and insurers benefit directly from a dovish Fed. And finally, mega cap tech. Apple, Microsoft, and Nvidia, since they're still driving the indices, if they rebound, the market floats higher. If they falter, the weight is heavy. If they stay steady, then the rest of the market has to catch up, and that will drive the indices. So what about our portfolio? So our stocks did great. We had a good month. We beat the markets. We climbed back into the race. For year to date, we're slightly beating the S&P 500, which is great because even though we own much of the Magnificent Seven, like Apple, like Microsoft, like Google, like Nvidia, we do own those stocks. We don't own them certainly in the concentration of the market, so it was always hard to beat that market. But now we have a broadening out of the rallies of the bull market, so we're participating in that. And August was the month that we slipped ahead. So how did the ValueAligned portfolio perform? We leaned on that rotation. Our cyclical and value names delivered strength, and some high growth tech cooled. But that's exactly why we build diversified portfolios. So let's look at the details. Our biggest star was small cap installed building products, up 27% in August, and it's up nearly 50% year to date. Housing completions and remodeling keep demand strong there. And General Motors followed, rising 12% and now up 10% for the year. Trucks, SUVs, and a disciplined electrical vehicle execution is driving results there. And most important, the reason why we own General Motors is because it's a truly value-aligned company. When Mary Barra took over as CEO, she changed the company back to its roots to be a value-based managed company, and they no longer were going after market share. They shuttered divisions that weren't profitable. They closed out Europe, and they concentrated solely on manufacturing and making sure that their break-even point is lower and lower so that they can manage through all the cyclical stuff. Hats off to Mary Barra. General Motors is extremely inexpensive because a lot of people have not recognized the power of value alignment at General Motors. They keep buying back stock. They have oodles of cash flow, and even the tariffs didn't slow them down. They quickly started moving production into the United States, resizing some of the plants that they have here and some of the plants they have in Mexico and Canada. General Motors has been not so surprised, but it's been pleasant, especially in August as the stock rebounded. Apple rebounded almost 10% in August, though still down year to date. Alphabet, the parent of Google, added nearly 9%, riding the recovery in advertising and cloud. AutoZone gained 8% in August, 31% year to date, proof that consumers keeping cars longer fuels the steady demand for car parts. Before we go on, I've got to mention AutoZone is a stock that we've owned almost since we opened the company 24 years ago. The fact is, AutoZone is one of the greatest value-aligned companies that you could ever imagine. They, in particular, have bought back 88% of their stock over the 25-year period. And the stock price has gone up 99 times. And their earnings per share over that same period of time is up over 90 times. So you can see that they manage for intrinsic value per share almost like no other company. And they have, in fact, benefited from that over the years. They're in a market that grows pretty steady 4% a year. That's what their market is, car part. They've grown the stock, 99 times in 25 years. Outstanding. We've owned the stock most of that period. And guess what? That's part of the strategy in action, right? We haven't sold a share and we have not paid any taxes, and we have reaped the benefit of our value going up and unrealized gains going up. And that's the strategy in action, folks. Now, Home Depot also rose nearly 8%, modestly positive on the year now. LVMH, Louis Vuitton, bounced back 7%. And it looks like some of the luxury goods sellers around the world look like they're bouncing back here in August through the rest of the year, which is good news. But remember, Louis Vuitton is still negative in 2025 as luxury sales, especially China, had softened at the beginning of the year. It looks like they're coming back. MedPace added 6%, up 43% this year thanks to biotech outsourcing. Copart rose 5%, even though it remains down year to date. Now, Copart, you probably didn't recognize the name because it's new to the portfolio. One of the stocks we rolled into in August is Copart is an online car auctioning salvage system. They basically are in an oligopoly. They've been in growth mode for the past couple of years. It looks like they're now slowing down a bit, and they're going to start buying back stock again. Just a good, well-run, family-owned company that is a value-aligned company. Anyway, we'll talk more about Copart another time, but just know that's new portfolio. And another new one, Novo Nordisk, the makers of Ozempic, gained nearly 5%, but still down over a third this year after a spectacular run in obesity drugs. There is a very fierce rivalry between Novo Nordisk and Eli Lilly here in the United States. They make Mounjaro. But let me tell you something. We own both of them because we got a break in the valuation because the stocks were down a lot. And people were saying mostly they were down for spot-specific reasons. There's some competition from off-label uses from when the companies could not get out enough of the product. But they've caught up now in production. They're cracking down on the generics. There's still a great deal of room to run in the obesity drug outlook. So here are the underperformers as well. Roper lost 6%, but is still up slightly on the year. Interparfums fell 6%, down double digits in 2025, as fragrance margins compressed, mostly due to tariffs. They got to work things out because they're a general contractor between the brands that they license, the names of the brands that they license, and then they make the fragrance by contract. So they don't do anything except put the whole thing together. Where depending on where they make it or where the supplies come from, they're having tariff issues. Taiwan Semiconductor slid 4%, but remains up 17% for the year, as this indispensable global chip foundry, especially for the AI world, continues to shine. Salesforce, a new company for us, lost 4%, down 23% in 2025. We're actually up on our purchase because we bought it in August. And we think that's a very undervalued company, at least by 30 some odd percent. And there's a worry there that artificial intelligence is to make every company a programmer, and it'll be very easy for them to get across the moat that Salesforce has developed over the years in customer relationship management software. Beauty, the stores, that's like 4%. It's still up 13% for the year, though. We bought some more Ulta. I'm not sure if it was in August, but we bought some more as it was down, and we topped off our position there. And we also topped off our position at the beginning of the year because we did not believe that the competition from Sephora, which is LVMH, we didn't believe that the competition from Sephora was going to erode its moat so much that we were going to forego high rates of return for too great. Plus, Ulta is a cannibal stock in the sense that it keeps buying back mega amounts of its shares. And Eli Lilly declined 4%, down 5% year to date, as supply constraints clouded its Mounjaro GLP-1 leadership story. What do we take away from August? One, market rotation is definitely underway, and hopefully it continues because we need a broader rally. Economic signals are diverging. GDP is strong. It was strong, but if I average the first two quarters together, it's not as strong as we'd like. It's not strong enough to prevent the Fed, in my opinion, from easing, so that's good. But labor is definitely softening, and that's part of the Fed's mandate to make sure labor doesn't soften too much. So a Fed cut is very likely in September still, but the concentration risk remains. 3 companies, remember, still dominate the S&P like never before. So if you own the S&P 500, you own one of the index funds, you basically have a 20 some odd percent position in 3 stocks. You probably never would do that in your own portfolio, but just understand that index funds are great, but the ones like the S&P index fund, the spiders, SPY, it's market capitalization weighted. So as more money piles into the index, it has to keep buying and buying the big stuff. And the big stuff keeps getting bigger and bigger and more concentrated. That means your performance now is going to depend on the fate of just 3 stocks. And in essence, a third of the index is now just in 7 stocks, the Magnificent 7. So looking ahead, as we move into September, expect volatility. After all, it is the worst calendar year of the month historically. A Fed cut could unleash more breath, though, especially in the small and mid-cap stocks and value stocks. But we'll keep balancing growth with value. That's what our mandate allows us to do, and it certainly paid off in August. The United States, with international and focusing on companies with strong fundamentals, That's how we stay aligned with compounding wealth over very long periods of time. Think AutoZone, think Roper. We've owned those for over 20 years. No sales. And no matter what the headlines scream. So if wealth is your goal, this is how we get there. Own great businesses, stay diversified. Don't let noise derail your strategy. Thanks for watching. And if you're ready to review your own, let's talk. And if you're already a client, let's talk, because I love talking about companies and the economy.